Good morning, students. Good morning, students. I welcome you all for the online class of business studies. Today we will be going to continue the business finance chapter. In that, today I will be going to explain you the next topic, that is capital structure. What do you mean by capital structure, student? Capital structure means a proportion of debt and equity. You know, business is formed with the help of capital, and that capital is not only accumulated from the owners of the business, but also it is taken in some of the form in the borrowed fund, that is known as the debt. Okay, so capital structure means the proportion of debt and equity used for financing the operation of business. Capital structure thus itself equals to debt divided by equity. In other words, capital structure represents the proportion of debt capital and equity capital in the capital structure. What kind of capital structure is best for a firm is very difficult to define. Means whether the ratio of debt will be more, equity will be less, or whether the ratio of equity must be more, debt must be less. That always it is not sure that business must have the equity more debt. It depends on the circumstances and situations. Some of the time our debts are more as compared to equity, but that time our credit worthiness will be less in the market. People will not be having the trust, because a person who is overburdened with loan, no one will be trusting that person, no one will be contributing any help for that person. So same is the capital structure of the company. When the debt will be more, people will hesitate to give more loan to the company. So let us discuss what the ratio of debt and equity must be there. The capital structure should be such which increases the value of equity shares or maximize the wealth of the equity shareholders. Debt and equity differs in cost and risk. As debt involves less cost but it is very risky security, whereas equity and expensive securities, but these are safe security from company's point of view. Why? Debt involves less cost, has but a very less rate of interest. We are getting the money to form a business, but how it is risky? It is risky as compared to equity, because equity shareholders are the owner of the business. They will not ask time to time frequently the money, principal amount and the rate of interest. But when we talk about the debt, people who had given the money to us, they can ask the principal amount or the rate of interest regularly or at any time, specified time which is decided. If in that case we are not able to return back the money, definitely they can claim over the personal asset of our business. They can take action against us. So that point of view, it is said it is risky. Debt is more risky as compared to equity. Equity are expensive securities because we have to pay a fixed rate of dividend to the shareholders. They are expensive because a lengthy process is there for forming the shares of the company. We have to form the prospectus, we have learned. We have to form articles of association. We have to hire the experts, and the management has to be strong. Then only the equity can be issued. Equity shares can be issued. Okay. So it is a lengthy process as well as costly as compared to debt. But it is more safer than the debt. In case we have failed to pay the debt, security holders can claim over the assets of the company to meet the principal amount. So that only I explained. If we not, then they can take an action. Equity securities are safe security from company's point of view, as company has no legal obligation to pay dividend to equity shareholder if it is running in loss, but these are expensive securities. Capital structure of the business affect the profitability and financial risk. A best capital structure is the one which results in maximizing the value of equity shareholder, or which brings rise in the price of equity shares. Generally, companies use the concept of financial leverage to set up the capital structure. What is financial leverage? Now the question will arise. Trading on equity. It is also known as trading on equity. What do you mean by financial leverage? Do you think the formula is same? Capital structure and financial leverage? No. See here, student, in this particular financial leverage, just we want to know what is the proportion of debt in the overall capital. Out of the total capital, what is the ratio of debt? So financial leverage hence equals to debt upon equity. With debt fund, companies fund and earnings increase because debt is a cheaper source of finance. But it is very risky to involve more debt in capital structure. More debt will result in increase in earning only when rate of earnings of the company, that is return on investment, should be more than the rate of interest on debt. Both are rate of ROI. One is rate of interest and second is return on investment. If our return on investment is higher, it is better to invest in shares instead of taking borrowed fund, that is the loan, because rate of interest is low. If rate of interest is more than the earnings or return on investment of the company, then more debt means loss for the company. Definitely student, if rate of interest is more, return on investment is less, then we must not prefer debt, because if we are taking more borrowed fund from the market, we have to pay more rate of interest to the banks and other institutions from where we have taken the debt. So that is the point. To prove that owners of companies gain or earning per share is more when the debt is involved in the capital structure, we will take the following example in which company is using all equity capital in one situation, then include some debt along with the equity in second situation, and then add more debt along with the equity in third situation. Total capital equals to rupees 50 lakh. How much? Total capital equals to how much? Rupees 50 lakh. The equity capital equals to rupees 50 lakh, that is 5 lakh shares at the rate of rupees 10 each. Debt is nil. Definitely, capital is 50 lakh. If we have arranged all the capital with the help of equity capital, so no debt is there. So that is nil. Tax rate equals to how much? 30% per annum. Definitely, equity capital, whatever earning they will be doing, EBIT is given 7 lakh. Over this EBIT, tax will be deducted 30%. Situation 2. Total capital how much given? 50 lakh. Equity capital how much given? 40 lakh. 4 lakh shares at the rate of rupees 10 each. Debt, definitely 50 lakh capital have to be contributed. Out of that 40 lakh is the equity. Then remaining 10 lakh will be the debt. Tax rate here also how much given? 30%. Interest on debt how much given? 10%. There no interest on debt was there because no debt was taken. Earning here how much is there? 7 lakh. Third situation, total capital how much? 50 lakh. Equity capital how much? 30 lakh. 3 lakh shares at the rate of rupees 10 each. Debt how much? Out of 50, 30 is equities, then 20 will be the debt. Tax rate how much is there? 30%. Here also interest on debt 10%. Earning before interest and tax EBIT equals to rupees 7 lakh. In 3 of the situation, the profit is equal, that is 7 lakh. We have to calculate the earning after tax, because that earning after tax only will be the distributed among the shareholders. Earning after tax. Okay, so let us see how we will calculate. Let us now calculate earning per share in all the situation. A tabular data you will be forming. You will be having 4 headings. One will be the particulars. Where the particulars? Here the particulars. Headings, contents you will be writing situation 1, situation 2 and 3. The data which I had shown, on the basis of that only we are calculating. What is the EBIT in 3 situations? We have learned 7 lakh only in all the 3 situations, so it will be 7 lakh. Earning before interest and tax. It is EBIT means earning before interest and tax. So first we have learned equity shareholders or preference shareholder will get the part of the dividend shares only after paying off all the credits and the tax, interest. So let us deduct the interest first. EBIT minus interest. First situation, no debt we have taken, so no rate of interest will be there. If we are taking loan, then only it will be debt. If we will have debt, then we have to pay the rate of interest. No debt, no rate of interest. So here it will be 0. Second condition, out of 50, 40 was equity and 10 was debt. So debt, the tax will be calculated on the loan amount which we got. So debt was 10. So on 10 lakh, 10% the rate of interest when we calculate, we will get how much? 1 lakh. So 7 lakh minus 1 lakh, how much? 6 lakh. 7 lakh minus 0, what is 7 lakh? Now the second situation where the 30 is to 20 the ratio was there. Debt how much taken? 20 lakh. So on 20 lakh, if rate of interest will be calculated, how much it will be there? 20 lakh into 10%, 2 lakh. So 2 lakh, 7 lakh minus 2 lakh, here how much we will get? 5 lakh. So this, what amount we get is what? What it is? It is earning before tax. Interest has been calculated. See here what has been out of EBIT. Out of EBIT we have removed I. So what left out? EBT, earning before tax. How much earning before tax came? 7 lakh, 6 lakh and 5 lakh. Out of this 7, 6 and 5 lakh, we will deduct the tax. Tax rate how much? 30% per annum. Here will be the tax on the earnings. 7 lakh is the earning, 30% on 7 lakh, 2 lakh 10,000. Okay. Earning before tax, how much is there? 6 lakh. So 6 lakh into 30%, 1 lakh 80,000. On the rest, 5 lakh. 5 lakh into 30%, 1 lakh 50,000. See here student, this always student make a confusion. On 7 lakh we don't have to take the tax. Out of this 7 lakh we had paid some interest also. After paying interest, whatever amount is left out, that is our earning, but before tax. So we have to deduct the tax, we have to pay the tax. So tax will be deducted or charged on the amount which is left out. So here how much is left out? On 7 lakh the tax is there, that is 2 lakh 10,000. On 1 lakh 80,000 the tax is on 6 lakh the tax is there, that is considered as 1 lakh 80,000. Okay. Now the next 1 lakh 50,000 we have charged the tax on 5 lakh. 5 lakh 30%, 1 lakh 50,000. Okay. Now we will proceed one step again. Now from this EBIT, I is deducted, T is deducted. So now it is earning before tax, not earning after tax. What it becomes? After deducting the tax amount, that is 7 lakh minus 2 lakh, we get 4 lakh 90,000, 6 lakh minus 180, 4 lakh 20, 5 lakh minus 150, 3 lakh 50,000. Earning after tax, earning per share if we want to take, earning after tax divided by number of equity shares. So earning per share equals to EAT upon number of equity shares. 4 lakh 90,000 divided by 5 lakh. 4 lakh 20,000 divided by 4 lakh. 3 lakh 50,000 divided by 3 lakh. Okay. What rate get? That is earning per share. What is earning per share? The dividend per share is divided among the equity shareholder. Okay. That is known as earning per share. Earning per share, the formula is earning after tax divided by number of equity share. Number of equity share I will be doing, it will not be same. First 50 lakh capital, 5 lakh shares of 10 each, so 5 lakh the shares. Next second question, 40 lakh shares of 10, 4 lakh shares of 10 each, so number of shares how much was there? Situation 2, 4 lakh. Third situation, 30 lakh shares, means 30 lakh amount of the equity shares, equity capital. So 3 lakh shares of 10 each, so that is 3 lakh. So when we will divide, we will get this particular. What we are seeing, it is not like that when we owners are investing the capital, then only there will be rate of earning will be more. If we will contribute with the equity capital some of our amount of debt, then our capital earning per share will be increasing, because the thing is that when we are taking debt from the market, a fixed rate of interest is given back to them. If our profit will be more, from that profit we will be giving a fixed rate of interest, the rest part will be our earning. With the help of this borrowed fund, some of the time we can earn more rate of interest, more rate of dividend. So we have to invest the capital in such a form that debt and equity must match. If we compare the above table, we can see that in situation third, equity shareholders get maximum return, followed by second situation, and least earning in first situation. Hence, it is proved that more debt brings more income for owners in the capital structure. But this statement holds true only till rate of earning of capital, that is return on investment of the company, is more than the rate of interest charged on the debt. As we can see, return on investment in this example, how we will get a return on investment formula is, first of all, what is the formula? That is EBIT divided by total investment into 100. What was the EBIT? 7 lakh. Total investment 50 lakh into 100. What is the rate of percent? 14%. What is the return on investment came? 14%. Rate of interest in the question was 10%. So when the return on investment is more than the rate of interest, we will be having profit. Okay. If return on investment is less than the rate of interest, then equity shareholder lose by including more debt. Then more of equity is beneficial for owners of the company to prove this. Let us take an example where return on investment is less than the rate of interest. Situation 1, total capital 50 lakh, equity capital 50 lakh, 5 lakh shares into 10 each. Debt is nil, 30% per annum, interest rate 10% per annum. So here return on investment is how much? 3 lakh, return how much? EBIT 3 lakh divided by total investment 50 lakh into 100, 6%. Second situation, EBIT is 3 lakh, how much capital? 50 lakh, how much? 6%. Third situation also same, but percentage, rate of interest. 6% is less than the interest rate 10%. So here it is not beneficial to have equity shareholders more. It is needed the debt must be there with the equity. The second situation also shows that interest rate is 10%, return on investment is 6%, return on investment is less than 10%. So here it also says that more of with equity some rate of debt must be there. Okay. So this is the situation for today's class. Next class we will be learning more working capital, fixed capital factors with how the finance has to be arranged. Thank you for today's class. Have a nice day.